Very good afternoon, dear students. Myself, Husha. I'm a chairperson of the Department of Studies and Research in Commerce, Karnataka State Open University. I'm going to handle a subject called financial management. You all very well know already about the financial management. Since many of you are working, you'll be know how to manage the finance. Suppose if you take for your personal life also, so you must be knowing how to manage if you earn a salary. When come to a business, even the business management, the business organization must have to have a financial manager in order to manage this financial aspects of the business in a smoother way. So for this, every business organization will be having accounts and finance department to manage this financial aspects. So let us discuss now what is this financial management? What are we going to study under this financial management for your syllabus? So here, finance, we say it as a lifeblood of a business. Finance is a lifeblood of every business. Without finance, no activities can be moved from one place to another place. So managing of this finance is very, very important. Without managing it, if the company failures in managing the financial aspect of the business, definitely it lost its business. It cannot able to run in the market, and it cannot able to acquire the market leadership, or any activity will not be possible if financial aspect is not managed properly. Now let us understand this, what is called financial management. So we say financial management is a process, never ending process it is. So it is a continuous process of every business organization. It is a process of estimation. Estimation of what here? Estimation, take an example. I want to start a business, a small kirani shop. How much finance is required for starting up of the small kirani shop? So for that starting up of the small kirani shop, I estimate 2 lakh rupees is required. How I have been estimated this? This estimation is always based on the resources required for the business. It may be because I have to invest some amount for stock, I have to invest some amount for fixed assets, furniture, for renovation of building, or for leasing the properties, etc. For which I have estimated 2 lakh rupees is the fund which is required for starting a small kirani shop, for a startup business. So after the estimation, what next it is? After the estimation, we need to identify the sources. What we have to do? We have to identify the sources here. We classify these sources into a 3 main category here. One is a small term sources of finance, medium term for sources of finance, and long term sources of finance. One is a short-term sources of finance, medium-term sources of finance, and a long-term sources of finance. So what is this short-term sources of finance means? What does it include here? Short-term in the sense, the name itself suggests you that short-term is a period which is available for a period of less than 1 year. Any finance which is available for a period of less than 1 year is called as short-term sources of finance. If it is available between 1 to 5 years, the finance which is required for a period between 1 to 5 years, it is called as medium term sources of finance. And a period which is for more than 5 years, the finance required, then it is called as long term sources of finance. So these are the main 3 sources of finance. After the estimation of finance required for the business, every business organization should have to look into the sources, where it is available, where I have to go get it, whether I have to go for a short-term sources of finance or a long-term or a medium-term sources of finance. What it is comes under a short-term, medium-term, and long-term sources. Suppose for a short-term sources, we can say customer advances, hand credits, bank credits, short-term loan from banks or financial institutions. So these are the sources of short-term sources of very few short-term sources of finance. And come to the medium-term sources of finance. For this, the company may issue the medium-term preference share capital, debenture, but not equity. Only the preference share capital, the debenture, or we can say that as a redeemable debenture, redeemable preference share. Why? Because they have an option. They can be the shareholders or the debenture holders can redeem that amount during the existence of the business, whereas for the equity shareholders, they are the real owner of the business, we say, so they cannot be redeemed during the existence. So that will not be the medium term sources of finance, only the preferential capital and the debenture. Along with that, even the gilted securities, the bonds, or any loan from banks or financial institutions will come under medium term sources of finance. Then come to the long term sources of finance. The very important long term sources of finance will be having equity share capital, preference share capital, debentures, venture capital, or even a long term loan from banks or financial institutions. Like this, they can go for estimating the finance based on the availability of sources. Next, after identifying the sources, okay, sorry, here many are saying the PPT is not clear. Actually, the PPT is visible. Maybe there is a problem with your internet connection, problem from your network issues. Kindly check it. There is a network is smooth working here, and even the PPT as well as the video, everything is clear. Voice is also clear. Kindly check it once again. Is it clear from all of your side? Okay, so after identifying the sources, next is deciding the capital structure. Deciding the capital structure. What is this capital structure means? See, the beginning, the first and foremost process is we have to estimate the finance required for the business. After the estimation, next thing is we have to identify what type of sources available here. After identifying the type of sources, next it is deciding the capital structure. What to be decided here as a capital structure? What it means here? Capital structure is nothing but it is a combination of debt and equity. What is capital structure? Capital structure is a combination of debt and equity. So this combination of debt and equity mix is called as capital structure. See, whatever the kind of business, every business, even if I am starting a kirani shop, small kirani shop, I may not start this business with my own capital. Even though I have a sufficient 2 lakh rupees, I may borrow from some amount of fund from the external sources. Or even if I start from my own capital by investing 2 lakh rupees entire my own money, in case if I go for extension or expansion of my business, at least by that time I require some amount of borrowed money. So every business organization, if they go for a combination of debt and equity mix, then it will be benefited for every business organization. How it is benefited, we'll discuss in detail along with the problems relating to this capital structure later. Okay, so this, what is debt here? Debt is nothing but a borrowed money, and equity here, equity is nothing but a own fund. So the combination of own fund and the debt capital, the mixture of this is called as capital structure. When the organization is going for investing own fund along with the debt capital, then they can have many more advantages. How means they can have a tax advantage if they will willing to take risk when they go for borrowing money, because when they borrowed money they have to make a repayment of capital along with the payment of regular interest, so for which they have to work hard. So these are all the benefit when they go for even acquiring the debt capital. After deciding the capital structure, next thing is every business organization must have to acquire the fund. They have to acquire the fund. So Here, we have decided the amount which is required for the business. Then also we have identifying the type of sources. We have decided the capital structure, that is a combination of debt and equity. Then we need to acquire the fund. So based on the estimated finance, whether we need short term or long term, or we need own fund or the borrowed fund, then we go for acquiring the fund based on the estimated. How much we have to acquire here, whether we have to acquire the entire 2 lakh rupees or less than 2 lakh rupees or more than 2 lakh rupees is a question here. Every business organization or the financial manager must have to acquire the required fund. The accurate fund which is required for the business must have to be acquired here. Why? Because in case if there is an excess of fund acquired, what happens? The money will be idle in the business organization where they cannot utilize that excess amount because they need only 2 lakh rupees. Instead, we have acquired 2 lakh 50,000. This 50,000 is idle in the business, but this amount is somebody's money for which we need to make a payment of interest. So when we are not utilizing this 50,000 rupees, how can it is possible to make interest amount for that, right? So there is a difficulty when they acquire excess of fund. And even if it is a shortage also is a problem for the business. Why? I need 2 lakh rupees. In case if I acquire only 1 lakh 50,000. If I acquire only 1 lakh 50,000, is it possible to run the business smoothly? I may not completely utilize the amount by investing either on stock or on furniture or any other. I cannot able to maintain some amount of working capital to meet the daily needs of the business. So this will be a problem. So every manager of the organization must have to acquire only the estimated or the required finance for the business. After acquiring the fund, what next is the procedure? What next is the procedure after acquiring the fund? Acquire ಮಾಡ್ಕೊಂಡು ಅದನ್ನ ಬೇರುನಲ್ಲಿ ಬೇಗ ಹಾಕಿ ಇಟ್ಬಿಡೋದು ಅಲ್ವಾ? Is it correct? So after acquiring the fund, that must have to be utilized, right? So it has to be invested. It has to be invested. So this is the process of financial management. I'll repeat once again. Financial management is a process of estimation, identifying the sources, deciding the capital structure, acquiring the fund, and finally investment of fund in order to run the business smoothly. So where they have to invest here is a question. They have to make a decision for this, right? So where they have to invest, whether to invest on the current assets or to invest on the long-term assets is a question here. Look at here. We know the format of balance sheet, right? What does this balance sheet format includes? Left side is a credit side and right side is a, left side is a debit side and right side is a credit side. Am I correct? Is it correct? What we say the format of balance sheet? Is it a debit and credit side of the balance sheet? We never say this balance sheet as an account. It is a statement. So when it is a statement, we are not going to mention this as debit or credit. Why? Because when there is an account, we mention that as a debit and credit. But this balance sheet need to be get tallied. So we say this as asset side or liability side or left side or right side. But now that is a old format of balance sheet having liabilities and assets. Liabilities on the left side and assets on the right side. But no organization, many of you will be knowing when you are working in the accounts and finance department, no organization will prepare this balance sheet as a liabilities and by showing liabilities and assets. Instead, they say this as sources of fund and assets as applications of fund. Assets as applications of fund. See here, liabilities means the fund where it is available. where the funds are raised from. What are the sources of funds which have been used by the business organization? Always balance sheet should get tallied, right? Why it should get tally is a question always. Why balance sheet should get tally always? So why? Because this sources of fund is always depends on the application of fund. Sources of fund is always depends on what? The applications of fund. So whatever the fund which is required for your business, when you are raised, suppose for this 2 lakh rupees, I invested 1 lakh rupees of my own capital and another 1 lakh rupees from the borrowed capital. This 2 lakh rupees I raised for the business, for the setting up of my business. This 2 lakh rupees, how I have estimated? This estimation of fund of 2 lakh rupees is based on this assets, that is applications. What does this asset side or the liability side includes? Mainly, I classify this as liabilities, long-term liabilities as long-term liabilities, and assets as long-term assets. And on the liability side, we also classify this as short-term liabilities and assets as short-term assets. Short-term assets. Can anyone say? Can you you can mention in the chat box, what does this long-term liabilities includes? What does this long-term liabilities includes? This long-term liabilities, in the sense, it is a capital portion, then reserves and surplus, that is share capital, reserves and surplus, and also the long-term secured and unsecured loans will come under long-term liabilities. Yes, very good. Debenture, equity share capital, long-term share capital, loan, secured loan, unsecured loan. Very good. Provision. No, provisions will not come under long-term liabilities. Okay, only the long-term loans comes under long-term secured and unsecured loans comes under long-term liabilities. Very good. Next is, what comes under short-term liabilities? Short-term liabilities, which includes the short-term loans, which comes under the current liability aspect. That is current liabilities and provisions, what we say, that is called as short-term liabilities. I'll repeat once again. The current liabilities and provisions, what we say, that is called as short-term liabilities. When come to the asset side of the balance sheet, asset side under the long-term loans, there is a fixed assets and investment portions. Fixed assets and investments comes under long-term assets, and short-term asset, under the short-term assets, we mentioned the current assets and loans and advances. Current assets and loans and advances comes under short-term asset. Now, my question to you is, in order to take an investment decisions here, whether the company should go for long-term liabilities or the short-term liabilities to acquire the long-term assets called fixed assets. I'll repeat once again my question. In order to acquire fixed asset is a long-term asset, right? To acquire this fixed asset, whether the company should go for using the sources like long-term liability or short-term liability. Can you anyone specify quickly? To acquire fixed asset, whether to go for long-term liability or a short-term liability sources? Quickly, fast. Very good, very good. Vinu Manu has replied it as long-term liability. Very good. Anyone? Okay. Even Arpita, okay. Very good. Fixed capital must be used. Okay, in order to acquire the short-term assets, so we say that short-term liability is required. So why? Because long-term asset is an asset, like fixed asset is an asset which will be there in the business organization for a longer period, and return from that asset will be generated for a longer period, right? In case if you invest the long-term sources of finance on the fixed asset, what happens? The return will not be generated for a shorter period. Whereas you have to make the repayment of short-term liabilities within 1 year. So it is very difficult to make the repayment because the return from fixed asset will not be generated within 1 year. It will be for a longer period. In the same manner, even the short-term asset, in order to acquire this short-term asset, the organization should have to go for acquiring the short-term sources of fund. In case if they acquire long-term sources, what happens? The return from this short-term asset will be generated within a short-term period, but the payment of interest as well as the principal amount will be made, have to be made the payment for a longer period, right? So it is very difficult if the company acquired long-term sources to finance on short-term asset. So there is an investment decision must have to be taken by the financial manager to invest long-term sources of fund on the long-term assets. Long-term sources of fund on the long-term asset. This is called as long-term investment decisions. This is called as what? Long-term investment decisions. What is this long-term investment decision? Long-term investment decision in the sense the decision which is taken for investing long-term sources of fund on the long-term asset is called as long-term investment decision, and this long-term investment decision is also called as capital budgeting. Long-term investment decision is also called as what? It is a capital budgeting. You have problem based on this capital budgeting. We are going to discuss that in detail along with solving the problem. Next is investment of short-term sources of finance. Short-term sources of finance on the short-term assets. On the short-term assets is called as what? Is called as short-term investment decisions. This short-term investment decision is also called as working capital management. Is also called as working capital management. What is this working capital management means? Working capital management in the sense managing the short-term sources of fund to invest on the short-term asset is called as working capital management. Okay, you have problem even based on this working capital management. So we'll discuss if time permits for all this. Next, you have problem even based on this capital structure. We are going to discuss this problems relating to this capital structure, capital budgeting, and working capital. So with the meaning itself, I'm going to cover up all the concepts and comes under the financial management. The very important concepts comes under financial management. So next is we discuss the financial decisions. Financial decisions. There are actually 3 types of financial decisions. One is financing decisions. Financing decision. Second one is investment decision. Third one is dividend decisions. All these are based on these 3 decisions: financing decision, investment decision, and dividend decision. So look at here. Financing decision is nothing but a capital structure. Financing decision is nothing but what? Capital structure. The decision which is taken for acquiring own fund or borrowed fund. That is a combination of debt and equity mix is called as capital structure. That decision maybe like the company can go for acquiring entire amount of equity capital, that is equity capital only, or the company can go for a combination of equity capital or a preference share capital, or it can go for having a combination of equity capital or debentures, or it can even go for acquiring the fund by using equity capital, preference share capital, or debentures or debentures. Like this, the various kinds of combination of capital can be raised by the business. You can check here, for all the combination there is a equity capital. Without equity capital, why is it not possible to go for acquiring only a preference share or only a debenture or only a preference combination of preference and debenture? No, definitely not. Why? Because see, if I starting my own business, will I start my business without having my own capital? Only with the entire borrowed capital is it possible to start the business? Even if you start the business only with the borrowed capital, what happen? There will be high risk. It leads to a high risky business where it is very difficult, right, to run the business smoothly. So if there is a combination of equity and debt capital, then it is called as an ideal capital structure. If there is a equity capital of 2 ratio, we can say 2:1 ratio of equity and debt. That is, own capital is double than the equity capital. If it is in this ratio, then 2:1, then it is called as ideal capital structure, ideal ratio of capital structure, where equity capital must be double than the debt capital. So otherwise it is very risk for every business management. Next, when come to dividend decision, as we discussed, it can be a long-term investment decision or the short-term investment decision. But one thing here, when the company is going for either long-term or short-term investment decision, it must have to keep it in mind that whenever after acquiring the finance, whenever it is going for investing the amount on the asset, it should keep some amount of liquidity position, and it should have to check the profitability and also the safety. But first and foremost thing is safety, liquidity, and profitability. These are the very important 3 principles every business organization must have to look into before taking a decision relating to an investment. Okay, so suppose I have 1 lakh rupees with me, that is a fund with me. I'm thinking where to invest this. I'm not doing any business, just this is my personal money. I have 1 lakh rupees in my hand. I'm thinking whether I have to invest this in the mutual fund, or I shall deposit this in the bank, or even if I decided to deposit this as a fixed deposit in the bank, whether I should go for nationalized bank or the cooperative bank. These are the question is there in front of me. So if I go for investing my 1 lakh rupees as a fixed deposit in either in the mutual fund or in the cooperative bank, I may get more interest. But will there be a safety for my amount is a question. So even if they give more amount of interest return also, I should check that whether is there a safety for my principal amount. If there is a safety for my principal amount, then I can take any investment decision. So first and foremost thing is every business organization must have to check. Every businessman must have to think of safety for the amount of investment. After safety, what next? So I have deposited my amount in the bank. 1 lakh rupees, I kept it in a bank as a fixed deposit, FD. What next? I had only 1 lakh rupees, that is a saving amount from my salary. But now I do not have even a single pie with me for another 1 month until the salary comes. What I have to do for meeting my day-to-day expenditure? So it is very much necessary to think even the liquidity aspect also, right? So here business organization must have to think of liquidity for meeting the day-to-day business organization. We can say that as working capital, the capital required for meeting the day-to-day business. So first thing is safety. Next is liquidity point they have to concentrate. After liquidity, the third thing is profitability. They have to check the profitability later after looking into the safety and liquidity. Say, take for example, bank. So what is the business of bank? Here every business organization their main activity nowadays, they are going for various other technology improvement, technology adoption also, but their main activity is what? Acquiring the fund from the public or from the customer and investing the same into the various activity, means acquiring the fund and investing the fund, right? That is the activity, acquiring the fund and investing, or through like investing on mutual fund or giving loan for the customers, etc. These are the activity of the bank. But when the bank acquired some amount of fund as a, or received some amount of fund from the customers or from the business as a deposit, that has to be utilized properly in order to make the interest payment to the customers, right? To make the return to the customers. So for which they have to utilize. So in order to utilize, what they do, they are going for investing, either providing loan to the required person, or they may invest that in the what, mutual fund. But here the question arises, if the bank acquired 10 lakh rupees of capital or the fund from the customer, received 10 lakh rupees from the customer, whether they have to invest entire 10 lakh rupees now? Do they have to lend entire 10 lakh rupees to the customer, or have to invest? Because they have to utilize that amount, 10 lakh rupees, entire 10 lakh rupees, right? If they utilize entire 10 lakh rupees without keeping working capital, what happens? I invested 1 lakh rupee today, but tomorrow, maybe for my personal requirement, I may not keep that till the maturity period. I may go and ask the bank again to premature my amount and to return the 1 lakh rupees which I have deposited in the bank. Because it is my money. The bank cannot say that you are deposited for 1 year or for 5 years. Until 5 years, you cannot take the amount. I may say you can charge for that, for a pre-closures deposit charges. I mean, any interest charges or the fine can be charged, but I need my principal amount back. So for which what happened, it is very much problem for every bank, that they have to maintain some liquidity position. Not only the bank, even every business must have to maintain some amount of liquidity position. After knowing safety and liquidity, then they can go for profitability aspect. Okay, this is about investment decision. And lastly, the very important is dividend decision. What does this dividend means? What does dividend means? Dividend is nothing but it is a portion of profit distributed to the shareholder as a profit, right? It is a portion of the profit distributed to the shareholders. It is called as dividend. So why this dividend decision required? There are actually various theories propounded based on this investment decision. This one can be like dividend relevancy theory, dividend relevancy theory, and next is dividend irrelevancy theory. Dividend, there are two authors propounded this dividend relevancy theory. Dividend relevancy theory is propounded by Walters and next is Gordon's. So we say that as Walters' model of dividend relevancy theory, Walters' model of dividend relevancy theory, and one more is Gordon's model of dividend relevance theory. So this Walters and Gordon's propounded this relevancy theory, and they say that there is a relevancy to decide about the percentage of dividend distributed to the shareholders. And this decision must be taken with a crucial manner. Why? Because if the company has provided more percentage of dividend to the shareholders, definitely it is positively benefited to the company. The market price of the share, the market value of the price of the share will go up, and it is even benefited to the shareholders. Whereas there will be less amount of reserves for the company. It will be affected to the company operational activities, whereas the market price of the share will go up, right? Because the shareholders think that the company is giving a good profit, good returns for them, so they will come forward. Even the prospective new investors will also come forward to invest on the company's shares, right? But even Gordon also says that, Walters and Gordon's, they both say that there is a relevancy in deciding the dividend decision. In case if the dividend reduced, the percentage of dividend reduced, what happens? It is negatively affected to the business organization, right? So there is a necessity of deciding the percentage or the return given to the shareholders. But there is one more author. He says that there is not required to decide dividend. There is not necessary to break our head to decide about this percentage of dividend to be given to the shareholders. There are the we say that as theory or model. Modigliani, his name is Modigliani Miller. Model. Modigliani Miller, he says that there is not necessary to make such a dividend decision. Why? Because here, to whom we are giving this dividend? This amount of dividend is given to whom? It is to the shareholders, right? Shareholders are the owners of the company, and whatever the return given to the shareholders or the part of the profit kept in the company as a reserves, both are belongs to the shareholders only, because they are the owners of the company. Whatever the amount kept in the organization or paid as a dividend to the shareholders will be the fund of the shareholders. So what is there to break our head to make this dividend decision? Because both the profit, the entire amount of profit is belongs to the shareholders. So this is the approaches of Modigliani Miller. So these are the dividend decision. We have a problem based on this Walters and Gordon's model of dividend decision theory. Let us discuss that problem also in detail later. Okay, now this is about the basic concepts of financial management, as we have discussed from the beginning how to estimate, and this estimation is based on what, and where are the sources, what are the sources available here, and when the sources are available, whether the company should go for acquiring the own fund or the borrowed fund or the combination of these two. And after deciding the capital structure, they have to acquire only the required fund, neither excess nor shortage. Then later, after this, finally they will take a decision. For taking decision, they must have to keep this in mind, that is safety, liquidity and profitability aspect. And when they go for long-term investment decision, we call that as a capital budgeting. If they are making a short-term investment decision, we call that as a working capital management. We have problems based on these two also. We'll work out that later. Next, when come to the dividend decision, we have various approaches, the models of dividend theories. Okay. Now, let us discuss the problems quickly one by one. Now, I go for the capital structure. As you all know about the concepts of financial management, that is including capital structure, I quickly move to the problem. But before going to the problem, I have to explain about the income statement related to this. Why this income statement required? As we know, capital structure is nothing but capital combination of debt and equity mix, right? Where the company can decide whether to go for equity share capital or debt capital, or the combination of equity capital, equity preference, or the combination of equity and debenture, or all the combination equity preference and debenture, right? So when they are going for these kind of various decisions, here the business is thinking whether to go for only equity capital or combination of equity and debt capital, or the combination of equity preference and debt capital. So for which we will be having some information relating to that. Based on the information given, we have to suggest for the company that which plan is best suitable, whether to go for equity or combination of any mixtures given in the problem. Based on that, we have to suggest for the company. So for suggesting the company, we will calculate EPS, that is earning per share. EPS, earning per share. We'll do that with this income statement. Okay, this income statement for this capital structure, we are preparing an income statement here. This income statement, which includes, first thing is particulars, and next is amount in rupees. Okay, what does this first include? Sales. So there is some amount of sales, and with this sales, if you deduct total cost, what do you get? This total cost includes both fixed as well as variable cost. So total cost includes here fixed as well as variable. So when sales minus cost means what? Sales minus cost is what? Profit. Am I correct? Right? Sales. When you deduct cost from your sales, the remaining what we left? Profit. Right? So this is a profit called as operational profit, and in this financial terminology, we call this operational profit as EBIT. What is this EBIT means? EBIT is earning before interest and tax. EBIT is earning before interest and tax. So this EBIT is the profit before deducting interest and tax here. EBIT is a profit before deducting interest and tax. So from this profit, first what we have to deduct? We have to deduct interest. Before deducting tax, all kind of expenditure must have to be deducted. So now deduct, all the expenditures are already deducted. Now only the left out is interest and tax. So it is called as earnings or the profit before interest and tax. Now deduct interest first. If you deduct interest, what you get? The balance. The balance what you get is called as EBT. EBT means what? Earnings before tax. Earnings before tax. This is a profit after deducting all expenditure but before deducting tax. Next is after deducting interest, what we next have to do? We have to deduct tax, right? Deduct tax now. I'll share this, the Word file which I am doing. In the Telegram group, I'll share this also. Okay, just look at and understand the concept. After deducting tax, what do you get? It is EAT, earning after tax. What is this EAT? Profit, which is available after deducting all kind of expenditure. This is available to the shareholders as a profit. This is earning after tax. Okay, next is we have to deduct this profit available now to the shareholders by giving preference to the preference shareholders. EAT means what? As I said, EAT, it is not EAT. EAT, it is earning after tax. So this earning after tax, it is available to both the shareholders. Mainly in the company, there will be two types of shareholder. One is equity shareholders and other one is preference shareholders. This equity shareholders are the shareholders, real owners of the company, but still the preference will be given to the preference shareholders. As the name itself suggests, preference shareholders must be given the preferential rights at the time of making the payment of dividend and also at the time of repayment of capital at the time at the winding up of the company business. So here now let us deduct preference dividend, preference dividend. If you deduct preference dividend, the balance what you get is completely available to the equity shareholders. So we say that as earnings available to equity shareholders. Equity shareholders. I'll repeat once again, this is income statement. This income statement which includes sales from the beginning. If sales is not given, if in the problem they have given EBIT directly, you can start your problem from the EBIT only. Not required to start from the sales by deducting total cost if there is no information. You can directly start from EBIT. So sales minus cost is operating profit, that can be called as earning before interest and tax. From this, if you deduct interest, the balance what we get is EBT, earning before tax. If you deduct tax from this EBT, what you get, the balance is called earning after tax. Then deduct preference dividend from this EAT, earning after tax. Then the balance what we get is called as earnings available to the equity shareholders. By using this earnings available to the equity shareholders, we can calculate earning per share. How to calculate earning per share? Earning per share is equal to earnings available to the equity shareholders divided by number of equity shares. This is the formula for calculation of EPS. What is the formula? EPS is nothing but earning per share. Earning per share. Earning per share is equal to earnings available to the equity shareholders divided by number of equity shares. So this earnings available to the equity shareholders, it is a fund which is available to the shareholders and divided by what is the actual shares. It is not share capital, share, the number of shares of equity shareholders. So that must be divided to calculate earning per share. So now let us work out one problem based on this capital structure. I'll share the problem. Even have shared the question papers to you also. We'll solve one problem based on the question paper. I have sent the question paper, starts from 2009 to 2016 to you. It is available with you in the Telegram group. I have shared it. You can check it. Now, we'll do one problem based on this capital structure. Okay, it is 2014 question paper. 2014 question paper. You can check it, the 2000 question paper. So the second problem, 2014, second problem of the question paper, financial management. I'll copy the question paper, the question here, the second question of 2014. Glorious Company Limited. This is a 2014 question paper. Okay, 2014. Look at here. Glorious Company Limited is capitalized with 10 lakhs. Is capitalized with 10 lakhs divided into 10,000 shares of rupees 100 each. I cannot share the entire, I cannot share the slide of entire question paper to you. So I copied the screenshot of this, only the particular problem relating to 2014 question number 2. You have complete question paper, you can look into it, and even you can work out many more problems by by checking the other question papers also. Okay. So look at here. In this problem, the company has 10 lakh rupees with them. 10 lakh rupees of capital with them. This 10 lakh rupees of capital is divided into 10,000 shares of rupees 100 each. And the management decides to raise another 10 lakh rupees to finance a major expansion program. Means the company is already having 10 lakh rupees and it is decides to go for expansion of the business, for which it requires another 10 lakh rupees. Okay, so this 10 lakh rupees of capital is divided into 10,000 shares of rupees 100 each, that is the existing capital. And for another 10 lakh rupees, let us look into the problem. They have given various financial plans. Further, they said there are four possible financial plans. First one, all equity shares. See, there is already existing capital of 10 lakh. Along with this existing capital of 10 lakh, they are going for additional equity capital. So I'll give time for you. Can you, till the explanation, you can send your answer in the chat box. What is the name of the capital which is there in the company? There is already existing 10 lakh rupees of capital in the business, right? So you can tell me what capital is there in the company, whether it is a equity capital, preference capital, debenture, or any other capital. You can tell me in the chat box. Okay, first for an additional expansion, the first point is equity, means entire equity share capital they are raising for an expansion, for additional capital. And the second plan is they have a plan of going for combination of 5 lakh rupees of equity share and another 5 lakh rupees of debenture carrying 5% interest. For a debenture, there must be fixed interest, right? So this 5% is a interest. And for the third combination, there is a 5% interest of all debentures. There is a 5% of all debenture for an additional capital here. And the fourth one is 5 lakh rupees of equity share and 5 lakh rupees of preference shares. And for the preference also, there must be fixed dividend. So for a preference shareholders, there will be a fixed rate of dividend. So they have specified here as 5% dividend. Further, they said the company's earnings before interest and tax. What it means? It is EBIT, right? EBIT is rupees 1,20,000 per annum. So they have given EBIT, it is 1,20,000 per annum. You are required to compute the earning per share under all the above financial plans. Assume tax rate is 50%. And also calculate the earning per share if an account of expansion, the EBIT doubles. See here, there are 4 financial plans for an additional expansion of the business, that is combination of equity or equity and debenture or combination of equity and preference. And they are also saying here, look at here at this point, they are also saying that if the EBIT doubles, what is the present EBIT? That is 1,20,000 rupees, right? In case if the EBIT doubles, also calculate earning per share on account of expansion. Okay, this is about the problem. Okay, let me see what are the answers I received for this. Okay, many of you are responded saying equity. Very good. So anything for any capital, if it is not specified, means it is an ordinary share capital or can be called as equity share capital. So there must be own capital in the business, right? So this is the existing capital is own capital, that is 10 lakh rupees of own capital. Okay, dear students, it's already 1 o'clock. If you wish, I'll continue for another half an hour because there is a lunch break now from 1 to 2 o'clock. I can complete this problem for you. So from tomorrow onwards, we can move to the other problem. You can mention in the chat box. If you wish to continue, if you want me to continue for another half an hour till 1:30, I'll take and complete this problem. Respond fast. Yes, okay. Let me complete this problem. See here, look at here, there is a 10 lakh rupees of existing capital, right? So quickly move on to the income statement. Take this income statement, but this income statement here, not only for one plan. There are 4 plans here. One is equity capital, equity and debenture, and only debenture, and a combination of equity and preference share capital, right? So, okay. Now I'm setting the column for all the 4 financial plan. Before to that, let us write this as a case 1. This is a solution having 2 cases here, right? One is when when the EBIT is rupees 1,20,000. EBIT is 1,20,000 per annum. This is case 1. Okay. Next is, what is the next case? Case 2, you can say calculate EPS for all the 4 financial plan when EBIT doubles. When EBIT doubles. Doubles means what? It is rupees 2,40,000. There is already an existing of 1,20,000 per annum, right? So next you can, when the amount of EBIT doubles, what will be the EPS is the question here. Now let us do one by one. This is the first case. Okay, so now for this, there are 4 columns along with one particular column, means totally 5. Okay, this is plan 1, plan 2, plan 3, then lastly it is plan 4. What is there in plan 1? See here in the plan 1, there is already an existing of capital of equity, and an additional, for an additional also they are going for equity. Am I correct? For the first plan, you can look into the question paper here, the 2014 question paper, you can check it there. The 2000 question paper second problem, they have said for the first plan is, for existing there is a equity already, and for an additional there is equity again, completely equity capital. Then come to plan 2. For plan 2, there is existing is there for the existing capital for all the combination, for all the plans, existing is equity only. So I'll copy same thing. Existing is equity only. Whereas for additional, which capital is there? For an additional combination, look at here, there is an additional combination of equity and 5% debenture. Combination of equity and 5% debenture. Equity and 5% debenture. Equity and 5% debenture. Next, for the third plan, existing is already equity and additional is only 5% debenture. Additional is what? Additional capital is 5% debenture completely. Next, for the fourth plan, existing is equity and additional is equity and preference share, 5% dividend, 5% debenture. Preference. Additional is equity and 5% preference. So this is the plans, right? This is about plans. Now let us move into an income statement. What is the first item we have to take? Shall we take from the sales? No, right? Why? Because see, if PPT is not visible, it is not from our side. There is completely our network as well as internet connection is good at our end, but you have to check. So somebody, Hemant, see, he's mentioning, you have to check it. If you are using your mobile phone, you have to keep your quality to the higher version. Okay, so if you do that, it will be visible for you. Next, first item is, I take this as EBIT because sales information is not given. Look at here in the problem. Here, the company's earning before interest and tax they have mentioned. Company's earning before interest and tax is rupees 1,20,000 per annum. In a sense, they have given EBIT. So we can move to the directly EBIT item. Okay. EBIT, earning before interest and tax. You have to specify this completely even in the examination also. If you write only EBIT, you may lose some marks. It is not that the problem is not correct, but you may lose some marks. In order to get good marks, you have to specify completely with abbreviation. Okay, earning before interest and tax, they have specified that it is 1,20,000 per annum. For all the financial plans, this is 1,20,000 only. 1,20,000 is the EBIT. What next for this? We have to deduct interest. Then this interest will be paid when there is a debt capital, right? When there is a debt capital, we pay interest. But when there is no debt capital, we don't pay debt. Sit in the Telegram group. I have shared the question papers. You can check it that. Somebody is saying we don't find. So it is available in the Telegram group. You can check it once again. See here, we have to deduct interest now. When we pay interest, interest will be paid only when there is a debt capital. Look at here in the plan 1, existing is also equity and additional capital is also equity. When there is an existing equity and additional equity, do we pay interest for the equity shareholders? Definitely not, right? We pay interest only to the debt holder, but for the equity shareholders, we pay dividend, not interest. So there is no interest in this column. It is nil. Next is in the second plan, existing is equity, whereas additional is a combination of equity and debenture. Additional is a combination of equity and debenture. Debenture is a debt capital for which we pay interest, right? What is the interest? Here, the rate of interest is 5 lakh. So we have to calculate interest for the second plan, right? I'll mention here separately. For plan 2, interest is 5% interest rate. But this interest will be calculated on what is a question. Do we calculate interest on this 1,20,000 rupees on EBIT? No, should not do that. Always, whatever the amount we borrowed, the interest must have to be calculated on the borrowed amount, but not on the profit. Okay. So what is the amount borrowed? Here for the second plan, look at here in the problem, 5 lakh rupees of equity and 5 lakh rupees of debenture they are borrowing, right? They are raising by issuing 5% debentures for 5 lakhs. So we have to calculate interest on 5 lakh rupees at the rate of 5%. Tell me what is the amount? 5 lakh into 5%. It is 25,000. Am I correct? From tomorrow onwards, I request you to have one is calculator with you, one is calculator, and also keep ready with the question papers. Okay. Next, 1,20,000 is the EBIT. Then interest amount for the plan 2 is 25,000. Next is, here in the third plan, there is completely debenture. Means what is the entire amount, expansion amount they are raising? Here it is 10 lakh rupees, right? This 10 lakh rupees is raised by issuing entire debenture with 5% interest. So therefore, for this calculation, we have to use 5% debentures for 10 lakh rupees. For plan 3, this is 10 lakh into 5% debentures. So 10 lakh into 5% debenture is how much? 50,000. Am I correct? If there is a wrong in the calculation, There is a wrong in the calculation. Kindly inform me. Okay, this is 50,000, 5% for 10 lakh rupees. Now, next come to plan 4. Existing is equity and additional is combination of equity and preference. Do we pay interest either to the preferential holders or to the equity shareholders? Never, right? We pay only dividend for them but not interest. They are not the debt holders. They are the shareholders. So we do not pay interest for them. 50,000, yes, correct. Next, deduct interest from EBIT. Now, if you deduct interest from EBIT, what we get? That is called as EBT. That is earning before interest. Earnings before, earning before tax, EBT. Now what we have to do? We have to deduct tax from this. Before to that, let us calculate what is the amount of earning before tax. This is 1,20,000 minus 0 means 1,20,000 only. 1,20,000 minus 25,000 is 95,000. Next 1,20,000 minus 50 it is 70,000. Next 1,20,000. Next, earning before tax. Now deduct tax from this. Deduct tax. What is the rate of tax? Look at here, they are specified in this problem that assumed tax rate is 50%. But sometimes what happens, I'm informing you the alternatives, all kind of alternatives in various other problems also. In case if tax rate is not given, what you will do? Do you take the tax amount as a nil? No, we are not supposed to take tax as a nil. When there is a profit, every business must have to pay tax. But when tax rate is not given, we can give a note for that saying, in the absence of information relating to the rate of tax, I hereby assuming the rate of tax at the rate of either 25% present tax rate or 50% for your convenience. You can write a note for that and you can continue with the problem by taking the rate of tax. But don't take that as nil, okay? Here, first one, tax is at the rate of 50%. If there is a 50%, it is easy, right? Calculation. 50% of 1,20,000 is 60,000 and 50% of 95,000. 1 second, I will also calculate. 95 means 47,500. 95,000 into 50% is 47,500. Then 70,000 into 50% is 35,000. Then lastly, it is 60,000. Now, if you deduct tax from EBT, what you will get? You will get EAT. What is this EAT means? It is earning after tax. Now, this EAT, the balance amount is 60,000. 50% is tax means remaining 50,000 is EAT, right? 47,500, 35,000, 60,000. Next is now deduct. First, what we have to do? We have to deduct preference dividend. Preference dividend. Deduct preference dividend. Look at here. What is the combination of capital structure in the plan 1? Existing equity, additional equity. Is there any preference share capital? No. So there is a nil preference dividend for the first plan. Next, even for the second plan, there is no preferential capital. Existing is equity and additional is equity and debenture. So there is no preference dividend. For the third combination, there is a existing equity and additional is entire debenture. Even there is no preferential capital. So no preference dividend. For the plan 4, there is an existing equity and additional equity and preference. Additional is equity and preference. So, when there is a preference share capital, we have to calculate preference dividend. So, what is the rate of preference dividend? It is 5%, right? 5% on what? Is it on the amount of profit 60,000? The amount of 60,000? No, right? Always we have to calculate either interest or the dividend on the debt or own capital, share capital. Okay. So what is the amount of preferential capital here? Look at here. Preferential capital is 5 lakhs. Equity combination of, for the fourth plan, they are going for raising combination of equity and preferential capital. So preferential capital is 5 lakh rupees at 5% dividend. Okay, now, so there is a preference dividend. Calculate 5% on 5 lakh. 5% on 5 lakh means it is 25,000. Now, deduct this EAT, I mean preference dividend from EAT. What we get, that is called as earnings available to equity shareholders. What is the balance? It is 60,000. Next 47,500, 35,000. Next 60 minus 25, it is 35,000. What next is here? Okay, look at here. We have to calculate what? We have to calculate EPS, right? What is EPS means? EPS means earning per share. For 1 unit of share, what is the returns given to the equity shareholders is earning per share. So this earning per share will be calculated by using what formula? The formula we can use by using calculate by using earnings available to equity shareholders divided by number of equity shares. Number of equity shares, right? So this is earnings available to equity shareholders. I have already calculated, but I have to calculate number of equity shares. I mark this as A and B. Why? Because to make the simple formula. What is EPS here for this problem? EPS is A by B. A is what? Earnings available to equity shareholders, and B is what? B is the number of equity shares. Is the number of equity shares. So now let us calculate what is the number of equity shares for each plan. For the first plan, and in the existing capital, there is a 10 lakh rupees of capital with 10,000 shares. 10 lakh rupees of capital with 10,000 shares. So existing, there is a 10,000 shares, but there is a additional also equity capital, right? So additional also entire equity share capital they are raising for an additional capital. So we can say entire 10 lakh rupees means again 10,000 shares by issuing, if they're not specified clearly. So we can assume that they are issuing for with the face value of 100 rupees only. When they are issuing with the face value of 100 rupees only, then it is 10,000 shares. How to calculate number of shares? Look at here. Number of shares you can calculate by using the formula like total capital divided by face value of capital. Suppose total capital is 10 lakh rupees and the face value is 100 rupees. How much we get? We get 10,000 shares, right? So like this, when number of shares are not mentioned in the problem, you can calculate by using this formula. So existing 10,000, additional 10,000 means totally we have 20,000 shares. Totally we have how much? We have 20,000 shares. Next, for an existing, always for all the plans, there is a existing of 10,000 shares. There is a existing of 10,000 shares and additional, look at here, for an additional, there is a combination of equity and debenture in plan 2. Combination of equity and debenture. So equity is 5 lakh and debenture is 5 lakh. So if there is a 5 lakh rupees of shares, tell me what is the number of shares? 5 lakh rupees of shares means what is the number of shares? 5,000, correct? It is 5,000. So total of 15,000 shares. You can calculate by using this formula also. 5 lakh rupees. Suppose, look at here, for plan 3, there is a 5 lakh rupees of capital with the face value of 100. So 50,000 is the shares. 5 lakh divided by 100 means 5,000. So not 50, sorry. 5,000 shares. So this is a total 15,000 shares. Next is 10,000. 10,000 is already existing capital. Number of shares. Along with this 10,000, are they raising any other additional equity capital? They are raising additional, the entire amount of additional capital is debenture. So additional is 0. Means only 10,000 shares. Next, for the fourth plan, look at the fourth plan. Here for the fourth plan, there is existing equity and additional combination of equity and preference. So combination of equity and preference means what? 5 lakh equity and 5 lakh preference. So if 5 lakh equity means 5,000 shares, right? 50%. 5,000 shares. So total is how much? 15,000 shares. So now we have calculated number of equity shares. A is earnings available to equity shareholders, and B is number of equity shares. Now divide this number of equity shares with earnings available to equity shareholders. A divided by B, that is 60,000 by 20,000. 60,000 divided by 20,000 is how much? It is rupees 3 per share. Next, for the second one, 47,500 divided by 15,000. 47,500 divided by 15,000. It is 3.167 rupees. 3.167 shares. Next is 35,000 divided by 10,000. 35,000 divided by 10,000 means it is rupees 3.5 per share. Finally, the rupees 35,000 divided by 15,000 is how much? 35,000 divided by 15,000. It is rupees 2.33 per share. This is earning per share. This is earning per share. Look at here, for all the for all the four plans, we have estimated earning per share. We have calculated earning per share. Yes, correct. Very good. This earning per share, many of you calculated this earning per share 3.5, 2.33. Very good. Now here we have to suggest for the company for this case 1. What is this case 1? Case 1 is when EBIT is rupees 1,20,000 per annum. When EBIT is 1,20,000 per annum, which plan the company should have to go? Whether plan 1, plan 2, plan 3 or plan 4. For this, we have to look into earning per share. In which plan there is more EPS, you can suggest that. For the first plan, there is 3 rupees, means only for their investment for 1 unit of share, they are getting 3 rupees as a return for 1 unit of share. Next, for the second plan, for 1 unit of share, they are getting 3 rupees 17 or approximately 17 paise. For the third plan, they are getting for 1 unit of share 3 rupees 50 paise, and for last plan it is only 2 rupees 33 paise. So now tell me, which plan is best suitable for the company for giving suggestions? You can suggest the company suggestions. Which plan is best suitable? You can directly say that plan C, plan 3. Plan 3 is best suitable. You have to write there 2 to 3 lines saying, after calculation of earning per share, we can see that plan 3 is having rupees 3.5 per share compared to all other plans. Means rupees 3.5 5 rupees of EPS is more in plan 3 compared to all other plan. Therefore, it is suggested for the company to go for a combination of existing equity along with only debenture for an additional expansion. Means you can suggest for the company to go for only debenture, completely debenture for an expansion program. Why? Because there is already existing equity capital. So they can go for additional entire debenture to get more returns. So this is the suggestions you have to say for the company. Look at here. This is for the case 1. What about for case 2? Case 2 is when EBIT doubles, what will be the earning per share? So for this, we have to again go for this combination. I have written here, one is particular, plan 1, plan 2, plan 3 and plan 4. For this, you have to calculate EBIT by taking 2,40,000. EBIT 2,40,000, because they said when EBIT doubles, what will be the earning per share? EBIT will be as it is, but you have to calculate interest, then deduct tax, then you have to even calculate preference dividend. At the end, calculate EPS after knowing earning available to equity shareholders and number of equity shares. So this is for your assignment. You have to do it from your end. Okay. So now I share this file, Word file to you. So that you can work out that problem. You can even check the question papers where there is a capital structure problem, and you can even check that. If you have any doubt, I will actually I will make this notification permission. I will give the permission for chat for today only till the class ends. Okay, if you have any doubt, you can send by messaging in the Telegram group. I'm giving a permission here, but not any other unwanted messages are not permitted here. If you want any clarification regarding this subject matters, you can send a message. If you are sending any unwanted, again I'll block. I'll make only the admin to send a message. Okay, I'm unblocking now, in the sense I'm giving the permission only when there is a information for you relating to the academic matters. You can send a message. I have given a permission for you to chat in the Telegram group, and I will send even now the Word file also. The Word file which I am working out. You can even do more and more problem, and if you have any doubts relating to this, you can send a messages to me to clarify your doubt. See, Telegram group link is already been given. Once again, I'll share here also. For many of you, it has been sent from the university itself. All the Telegram group link has been sent for you. Wait for a minute. This is January cycle 2021 batch link, and next July cycle batch link. This is about July cycle 2021 MCOM. First one what I sent is a January cycle, and second one what I sent is a July batch. I'm ending the session now. You can copy that link, and you can use it for joining the Telegram group. I'll share this Word file also to you after the ending of the class. If you have any doubt, you can ask me. You can send a message even in the Telegram group also. Okay. By tomorrow, this is about capital structure. Tomorrow we'll start with another concept. Okay. About either working capital or capital budgeting. We'll start with the capital budgeting by tomorrow. Okay. Thank you very much. Thank you.